Buying a house right now could ruin you. Three people walk into the same bank on the same Tuesday morning in 2024. First guy, 34 years old, makes $97,000 a year, has $60,000 saved. He's been renting for a decade, watching home prices go up every single year, and he's finally done waiting. He gets pre-approved for a $480,000 mortgage, signs the papers on a 3-bed, 2-bath in the suburbs. Feels like he finally made it. 6 months later, the roof needs $14,000 in repairs, property taxes came in $4,200 higher than the estimate, and his monthly payment after insurance is $3,800, which is 47% of his take-home pay. He hasn't contributed to his 401k in 8 months. Second person, 41-year-old woman, solid job, 2 kids, renting a perfectly fine apartment for $1,900 a month. Her friends keep telling her she's throwing money away. Her mother calls every Sunday to ask when she's buying. She does the math in her head, decides she can make it work, and purchases a home at 7.2% interest on a $390,000 loan. Her total interest over 30 years, $556,000. She is going to pay for the house twice. The bank will collect more than the seller did. Third person never buys, gets called a coward, gets called a renter forever. Quietly puts $2,400 a month, what others are paying over their rental cost and mortgage expenses, into an index fund for 15 years. Here's what all three of these people believe: that buying a house is the foundation of financial stability, the safe move, the responsible adult thing to do. They believe it because their parents believed it, because every financial magazine and real estate agent and well-meaning family member has told them it for their entire life. Here's what nobody told them. The math has changed, and if you're buying right now in this specific, I want you to think about an anchor. Not the metaphorical, emotional anchor from pop psychology, a real one. The kind they drop off the side of a ship to keep it in place. An anchor is a tool. Used at the right time, in the right water, it's exactly what you need. It keeps you stable. It gives you a base. But if you drop it at the wrong time, if you drop it while you're still trying to go somewhere, it doesn't stabilize you. It stops you. And the heavier the anchor, the harder it is to move, the more fuel you burn just trying to make progress against it. A 30-year mortgage at today's rates is an anchor. Used correctly, right time, right place, right price, it grounds you, it builds equity, it creates a permanent housing cost that protects you from rent inflation. But dropped at the wrong time, in the wrong market, at the wrong price point, it will slow down every other financial move you try to make for the next 10 years. You'll feel the drag on your retirement savings. You'll feel it when you want to change careers but can't afford to take a pay cut. You'll feel it when a job opportunity comes up in another city and you realize you're underwater on your home, or that selling it would cost you $40,000 in transaction fees on a house that hasn't appreciated enough to cover them. The anchor doesn't hurt you because it's an anchor. It hurts you because people confuse "this is a good thing in the right circumstances" with "this is always good." And the real estate industry, the agents, the mortgage companies, the finance gurus on Instagram, has spent billions of dollars making sure you believe the second version. So before we talk about the math, let me tell you about a woman named Margaret. Margaret is a fictional composite of a real pattern. She's 38 years old, lives in the greater Phoenix metro, makes $82,000 a year as a healthcare administrator, and bought her home in September of 2023. She had $45,000 saved, put $36,000 down on a $340,000 home, just over 10%, which meant she was on the hook for PMI, and financed the rest at 7.4%. Her monthly payment, $2,471 in principal and interest. Add PMI of $221, property taxes of $310 per month, homeowner's insurance of $185 per month. Total housing payment, $3,187 per month. Her take-home pay after taxes, $5,400 a month. Her housing cost is 59% of her take-home pay. The conventional guideline says 28 to 30%. She is running at nearly double that. But wait, she was approved for this mortgage. The bank signed off. The realtor said she was being responsible because she put down over 10%. Her mother said she was finally building equity. Her coworker said she was smart to lock in before rates went even higher. And she believed all of them because every institution in her life was aligned in telling her this was the right move. Now, let me show you what the anchor actually weighs. Let's do the real math, because this is where it gets uncomfortable. Margaret borrowed $304,000 at 7.4% for 30 years. The total amount she will repay over the life of the loan, assuming she never refinances, never sells, never pays extra, is $758,497. She borrowed $304,000. She will pay back $758,497. The difference? $454,000.
Here is the central myth I want to dismantle, because it is so deeply embedded in the American financial psyche that people get genuinely angry when you challenge it. Renting is throwing money away. This phrase has survived entirely on its rhetorical momentum. It feels like it's obviously true. You pay rent, you get nothing back. You pay a mortgage, you build equity. Simple. Except it isn't. When you rent, yes, you pay for housing and receive no equity in return. That's true. But the statement throwing money away implies you have another option, and that other option is free of equivalent costs. It isn't. The mortgage interest you pay, thrown away. Property taxes, thrown away. PMI, thrown away. Maintenance, thrown away. The gap between what you're paying now versus what renting the equivalent property costs, that delta, invested consistently, is not thrown away. It compounds. Let's go back to the third person from the cold open. He never bought. He kept renting at $1,900 a month. The equivalent house to his rent, let's say a comparable 3-bed, 2-bath, would cost him $3,200 a month all in to own at current prices. He takes that $1,300 monthly delta, the difference between owning and renting, and puts it in an index fund every single month. After 15 years at 9% average annual return, $491,000. After 20 years, $897,000. He has not been throwing money away. He has been renting the use of a house while systematically building wealth through a different vehicle. He has flexibility. He can move for a better job. He can downsize during hard times. He doesn't get a $14,000 roof bill. When the HVAC dies, he calls the landlord. Now, does this mean renting is always better? No, and I want to be precise about this because the nuance matters. If you are in a market where buying costs the same as renting, where prices are reasonable relative to local incomes and the monthly payment is at or near the equivalent rent, then the equity building tilts the math toward buying because you're not paying a premium for ownership. You're just choosing which address your wealth accumulates in. That calculus is real. It exists in some markets. It just doesn't exist in most of the markets where most people who watch this video are actually trying to buy. The problem is that home price-to-income ratios are at historic highs in most major metropolitan areas. In coastal cities, a median home now costs 12 to 15 times the median annual income. Let me tell you when the anchor makes sense. Because I'm not here to tell you never to buy. I'm here to tell you when the math actually supports it. Condition 1. When the total monthly cost of ownership, mortgage, taxes, insurance, PMI if applicable, and a maintenance reserve is within 10 to 15% of equivalent rent for the same property in the same area. This is called the price-to-rent ratio, and in a healthy market, it should be between 15 and 20. Right now, the national average is over 23, and in many desirable cities, it's 30 to 40. When the ratio is normalized, when you're not paying a massive premium for ownership over renting, the math shifts. Condition 2, when you have a genuinely long time horizon. Not, I plan to stay 5 years. 5 years is not a long time horizon for a 30-year mortgage in a high-price environment. The transaction costs alone, realtor fees, title insurance, closing costs on both ends typically run 8 to 10% of the home's value round trip. You need enough appreciation and equity building to absorb those costs before selling. In a normal appreciation environment, that takes 7 to 10 years minimum. If you can commit to 10+ years in a specific market, the long compounding of equity starts to make the math work more reliably. Condition 3, when your total housing cost is at or under 30% of your take-home pay, not gross income, take-home pay, because the 28% of gross income rule was designed in an era when marginal tax rates were much higher and effective take-home was closer to gross than it is today. Use take-home. If your total housing payment, everything, exceeds 35% of take-home, you are in the financial danger zone regardless of what the bank approved you for. Banks don't approve you to maximize your net worth. They approve you to maximize your loan repayment probability. Those are not the same thing.
There is a predictable objection at this point, and I want to address it directly because it's legitimate. But what about rent going up? At least with a mortgage, the principal and interest payment is fixed. My landlord can raise my rent every year. This is true. Rent inflation is real, and over a long enough period, particularly in high-demand markets, rent appreciation can erode the renter's advantage meaningfully. A $1,900 rent today might be $2,800 in a decade. But here's what the objection misses. First, the rent increase has to be compared against the interest rate cost. If you bought at 7.4%, you're paying an enormous interest burden in the early years. Rent would have to escalate significantly to overcome that embedded cost. Second, the fixed rate advantage is real but delayed. It doesn't really kick in until year 15 or later, after you've already paid the majority of your interest front-loading. Third, the investment delta, the difference between renting cheaply and investing the remainder, compounds at 9. There is a predictable objection at this point, and I want to address it directly because it's legitimate. But what about rent going up? At least with a mortgage, the principal and interest payment is fixed. My landlord can raise my rent every year. This is true. Rent inflation is real, and over a long enough period, particularly in high-demand markets, rent appreciation can erode the renter's advantage meaningfully. A $1,900 rent today might be $2,800 in a decade. But here's what the objection misses. First, the rent increase has to be compared against the interest rate cost. If you bought at 7.4%, you're paying an enormous interest burden in the early years. Rent would have to escalate significantly to overcome that embedded cost. Second, the fixed rate advantage is real but delayed. It doesn't really kick in until year 15 or later, after you've already paid the majority of your interest front-loading. Third, the investment delta, the difference between renting cheaply and investing the remainder, compounds at 9% per year. Rent would have to rise by more than your portfolio returns to make renting persistently worse. Over the past century, home prices have returned roughly 4.5% annually, including inflation, compared to the stock market's roughly 10.7% annually. The rent versus own decision isn't rent versus building equity, it's rent and invest versus own with opportunity cost. And the historical numbers favor the renter who invests more often than people think. None of this means you should never buy. It means the rent inflation. Let me be honest about the dimension of this that isn't math. There are real, legitimate, non-financial reasons to buy a home. You want to paint the walls. You want a place where your kids grow up and don't have to move. You want to feel the permanence of a place that is unambiguously yours. You want the psychological grounding that ownership provides. These are real. They're not irrational. They don't show up in a spreadsheet, but they matter. If those things are important to you, and for many people they genuinely are, then you have to weigh them. You have to decide what they're worth to you in dollar terms, and if the premium you're paying for ownership over renting is acceptable in exchange for those things, that's a legitimate trade. But you have to make that trade consciously. You have to say, I know the math slightly favors renting and investing in my situation, but I'm choosing to pay the premium because the non-financial benefits matter to me. That is a rational adult decision. What is not rational is making the decision based on the myth that the math always favors buying, because that myth is not true, and particularly not true right now, in this specific market, for most buyers at most income levels. The anchor metaphor is useful here again. Dropping anchor isn't wrong. Sometimes it's exactly right.
but drop it knowing what you're doing and why. Know what it weighs. Know you're going to stay in these waters for a while. Choose the anchor that fits your ship. I want to end with 3 concrete things you should do before you decide anything. 1. Do the calculation I described above, with real numbers. Don't let a realtor or mortgage broker run the numbers for you because their tools are designed to make buying look better than it is. Use your own spreadsheet or My Calculator. Link is in the description. Run the actual cost comparison with actual rent alternatives for the actual property you're considering. This one calculation, done honestly, will either confirm that buying makes sense in your situation or reveal that you're about to pick up an anchor that's too heavy. Either way, you need to